Hey guys, welcome back to Finances with Ferg. This is episode 2, Financial Basics 201. This will be one of the few continuation episodes in this season. Most of them are standalone. You can digest them and watch them on your own to gain the knowledge that's within them. But this is a good continuation from Financial Basics 101. So if you haven't seen last week's episode or if you didn't attend, would recommend checking that out, as there will be a few concepts that we jump off from for this week's episode. Now, as always, going to take care of a little bit of housekeeping first. Just a reminder of what we're doing here, how you can get more content, and just stay up to date with what we're doing. So if you want, you can check out the videos on YouTube. Obviously, that's probably how you're watching this. You can go to my Facebook, you can go to my Instagram as well if you want to see some memes, you want to see some quotes, you want to see some little tidbits of information that might help you along in your financial freedom journey. You can check me out at the end of the session. I'll be putting up my info there. After each session, if you are on the Finance with Ferg list, as in I've got your email, I'll be sending out summaries, cheat sheets, resources, basically the things that I go over in the calls or in these recorded sessions. I'll be sending out some info after to the people that I have their email. So if you'd like to be on that list and you're not already, you can just send me a note, shoot me a text, send me a message, and we'll get you on that list. Now, these are best suited for Ontarians and Albertans when it comes to the live sessions, as they are within those time zones. But these are pretty relevant for most Canadians. I'd say each province will have a couple differences here and there. Quebec will probably have a few more than some of the other provinces, but for the most part, a lot of these concepts can be related to you, no matter where you are here in Canada. Sharing and referrals are encouraged to help us do that. We do giveaways, right? We love giveaways here. So there are gift cards and prizes for people that bring friends, bring family, and grow that Finances with Ferg list. So moving on to today's session, let's talk a little bit about today's agenda. What are we going to be covering? Well, if you went to last week's session, you know it's just a continuation. This is the 201 version, but we will be talking about budgeting, a little bit more hands-on. I've actually got an example that I want to show you guys. I'm going to be talking about debt and debt restructuring. I've got a very, very, very cool concept to show you guys about debt and how you can actually save money on your debt moving forward if you implement these different concepts that we'll be going through. And then we're going to touch on investing. Now, normally next week would be our Investing 101 episode, but as we're coming up to the tax deadline, I do want to change the order a little bit. So next week we'll be talking about tax. So normally we'd be introing investing today, talking about it next week. Either way, we'll still be introing it today about a concept that might help you guys understand how do these TFSAs and Rrsp accounts come into play when we're talking about investments. And then, of course, at the end, we always leave some time for questions. But as this is recording, we probably won't have that many because I am alone on the session. But let's kick off the session talking about budgeting. All right. Now, when it comes to budgeting, I find like anything in life, it's the first step is the hardest, right? So to help you guys along here, let's start right from the beginning. Where do I begin when I want to start making a budget and start tracking my stuff? Now, on that topic of making a budget and tracking my stuff, I want us to start thinking about budgeting more in the terms of tracking rather than restricting. You can think of it kind of the same way as a diet, right? A diet can have two meanings. A diet can be restrictive in the sense where, oh, I can't eat that piece of cake because I'm on a diet. I'm restricting my calories. I'm restricting the types of foods I eat. There's also the type of diet where it's just what you eat on a normal basis. It's what you're tracking. Yeah, you know, my typical diet is da 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 da, right? I want you guys to start thinking about your budgeting in the same way. It makes it a lot easier to actually get one when you're not thinking of it in a restrictive way, just in a tracking way. Okay? So where do you begin, right? I recommend you use a template to get started. I'm going to send one out to everybody on the Finance with Ferg list. If you're not on that list and you want my template, just let me know. I'll show you an example of it here in a second. But use some sort of template. You can get them online too. You can just put it on a piece of paper if you've got nothing else. But that's typically the best place to start. Write down your monthly income after tax. So depending on how many streams of income you have, I want you to write them all down in this template or on a piece of paper after tax. Because what I think happens a lot is we tend to spend money like we've got the before tax amount, but CRA is going to get their piece. So we want to make sure that we're budgeting with whatever's left after tax. The next thing I want you to do, and I think this is the most important thing when starting with a budget, so that you can kind of get an idea of what you've historically been doing and what you've been spending your money on. Pull the last 6 months of spending. So credit card statements, debit card statements, anywhere that you're spending money, pull the last 6 months of spending, and this is where we're really going to get into building out this budget. Now, by taking a look at those last 6 months, right away you're probably going to see a couple things that you can cross off right away, right? Like maybe you signed up for a free trial and you forgot to cancel before you started getting charged, and you're not actually using it, right? That's a quick one. You can cancel it. Oh, hey, maybe you downloaded that latest video streaming service because it had a movie you wanted to watch, but you haven't turned it on in 2 or 3 months. Well, boom, there's another quick savings there for you. You'll probably find a few things like this, and yeah, just pulling the 6 months will help you do that. But to actually construct this budget, what I recommend you do is take a look at those last 6 months, the spending of the last 6 months, and start breaking them down into 4 categories. Okay, your constants, your needs, your wants, and your maybes. Now, your constants are going to be those things that you spend the exact same amount on every single month, and you have to keep spending on those things. So for example, car insurance, your mortgage or your rent, life insurance, whatever, the exact same amount every single month, and you have to have this. That's going to be in your constant section. Okay, you need to have those. Next, we're going to go to your needs. Now, these are just as important as constants in the sense that you still need them in your life and you need to pay for them every single month, but maybe they're not, maybe it's not the same amount every single month. So for example, groceries, you need to eat, right? So that would go in the needs pile because you need them, but you're probably spending something a little bit different each time. Gasoline, maybe hydro, maybe your phone bill, whatever it might be, things you have to have in your life, but the dollar amount each month is a little different. Now, for the needs section, I actually want you to pick the higher amount of the needs section. So for example, you've got 6 months of gasoline, okay? And maybe it's 100, 110, 120, 130, 140, 150. Make it easy. I want you to budget, if the 150 and the 140 were an absolute anomaly, don't use those. But if like, there's a pretty good chance that it could get up there again, or maybe like just under it, what I always recommend to people is budget in the sense that you're spending, like in your budget, write it down in a way that it looks like you're spending more on it, but in reality, you're probably doing a little bit less. Why? 2 reasons. First reason, let's make sure you never go over your budget, right? If you are sectioning out part of your income to pay for that on a regular basis and you never go over it, well, great. That's within your budget. That's what we're trying to do. And the second thing is, anytime you don't go over, which is hopefully every time, you have a little bit of extra that you can start putting towards your savings. You can start putting towards your investments. You can start getting ahead, right? That is what we're ultimately trying to do here from this budget, is start getting ahead. Now, moving down to the wants. These are things that, you don't necessarily need, but you definitely want them, and you want to keep them in your budget. You want to still keep allocating money for these things. Now you may not need them, but you definitely still want them. These would be things like maybe clothing, dining out, entertainment, things of that nature. Those would go in your wants. And then again, what's roughly the monthly amount? Inflate it a little bit so that you don't go over it. There you go. And then finally, the maybes. These are like, well, you could definitely live without them. They don't necessarily have to be in your budget. Write down all your budgets. Cross out a couple of the ones that really don't need to be in there. Move the ones that you do still want into the want section, and this will help you free up some cash as well. But that's kind of like the theory side of things, right? So get a template, write down your monthly income, track your last 6 months, break it down into different sections, and what you're ultimately going to end up having is something like this. Now I'm going to show you an example of Bob's budget here to see if yours kind of looks like this as well, or what yours can look like. So guys, here is Bob's budget. As you can see from the different sections here, these are already broken up for us. Now they aren't called constant needs and wants, but as you'll notice, they are color coded. So Bob has done that here for himself. But you want to separate the sections, right? So you've got any forms of income, any sources of income that you have up here in the top left corner, and then basically the rest is all where the money's going. Now, I do recommend you budget out your savings and investments because it is still a very important expense that you need to be considering. But what's nice about this sheet, which any finance with Fergers on the list will be getting sent, this will all calculate for you. So as you input your income, as you input each one of your expenses, it'll start to add up here at the bottom, and then finally it will show you how much money you can have left over by the end of the month. So again, if you are on the list, you've already got this. If you aren't, let me know. I can send you this template and you can start building out your budget this way. Talking about the color codes, anything in orange here are those constants, right? Every month, same price, does not change. Everything in blue are the needs, stuff that Bob needs to be spending on a monthly basis, will not pull out, but the prices vary. Now these are a little bit inflated to make sure that he never goes over his budget. And then the green are the wants. They don't necessarily need to be in this budget, but they are a part of Bob's lifestyle, so he wants to make sure that they are included. All right, thank you, Bob, for being so generous with your budget. Moving along here to the next page, let's talk about debt. This is the one I'm really excited about. And no, I'm not excited about debt, but I am excited to teach you how debt is not always the worst thing. All right, again, we've got another example that we'll be taking you through, which is going to be mind-blowing, trust me. Really excited to show you. But where do we start, right? How do I manage my debt? As you can, you got to know everything first, right? You got to get a good understanding of what's actually in your debt environment. Where are you currently in the negative, and what are you currently paying off on a monthly basis? Okay, so what you want to do is you want to find out what that is. You want to write it all down. All your debts, credit cards, loans, car payments, mortgages, whatever you're owing money on, I want you to put that in one column of this Excel sheet or piece of paper, whatever. Next thing I want you to do is I want you to record the interest rates, right? So what is the interest rate on that debt? It's your credit cards, typically 19 or 19.99, line of credit, 8%, mortgage, 3%, whatever it might be, I want you to write those down too. Beside that, I want you to write down what the minimum payments are. All of your debts probably have a minimum payment that is owed on a monthly basis. I want you to write that beside the interest rate. And then the next column, I want you to write down what you are actually paying, because a lot of us are paying more than the minimum payments. Even if we're not a big deal right now. But I want you to do the minimum payment and then what are you actually paying on a monthly basis. And then if you can figure this out, there are calculators online. You can message me and I can help you if you want. But how long will it take you to pay off that debt? Because that's really important too, to actually visualize and put a number to how long this debt is going to take you. I promise you, for most of the debts you have written down, you'll probably want to start putting a little bit more money towards it when you see how long it's actually going to take you and how much money it's actually going to cost. And again, I will show you an example of this here in a minute. Once you've written all that down, the next thing you want to look at is, can you consolidate any of those debts? Like, can you move one of those debts into another line of debt? Like, for example, if you've got, then you can see the question later on there, do you have a line of credit? So for the example here is, let's say you've got a credit card at 19.99%. You've also got a line of credit that would only cost you 6%. See if you can take the money out of the line of credit to pay off that credit card. Why? Because now you're paying a debt of 6% rather than paying a debt of 19.99. All right, this is going to save you a lot of money in the long term, in the short term too. It's just a much better way to do it. Lump sum, does it make sense at this time in your career or in your journey of financial freedom in your life to lump sum any of those debts? That's up to you. You can ask a friend, you can ask me, you can ask somebody who's maybe been in debt before and has gotten out, or you can just stay tuned for a few more minutes and see what I would say about that. But that'll be something you'll need to figure out too. Does it make sense to lump sum pay off any of these debts? And then at the bottom here is I want you to take a look at, well, the debt and the cost versus the invest and the income. And what that means is, does it make more sense to keep paying off your debt before you start investing? Because is it costing you more to be in debt than you would be making in terms of an income if you're investing? And how you need to look at this is you prioritize the biggest interest rate / rate of return / percentage figure first. Okay, so wherever the biggest percentage is, that's what you prioritize. So on a credit card that gets 19.99% interest rate versus an investment that gets you 6% return, your money is going to be prioritized by paying off that credit card, or at least it should be. Why? Because it is costing you more to carry that debt than you are making in income on that rate of return from the investment, right? 19.9 versus 6%. On the flippity flop, on the other side of that, if you've got an investment getting you 12% return and you've got a debt only costing you 6%, then it makes sense to pay off that debt at the minimum payment while you're still getting 12% on the investment over here, because that is now working towards or for you in a way that you're making more money than you're paying in your debt. Okay, and I'm going to show you an example of this here in a second. But before we get there, I want you to start thinking a little bit, which debt do you think would be better to pay off first, right? You've got a couple of different debts in there. What would you pay off first? The highest interest item or the one that carries the highest amount? Well, let me show you a couple of different strategies to see which it would be, and maybe it's a third option. I don't know. I don't want to spoil it, but let's take a look and see. All right, guys. Now here is the example I want to show you guys around restructuring debt and how valuable it can be to get your debt in a cheaper location, as well as maybe it doesn't always make sense to lump sum those payments. So let me talk a little bit about what we're seeing here. So here up at the top, we're going to start here, and this is what we would do if we were balance focused. So paying off the largest balance first. So as you can see here, we've got a few debts. We've got the balance carried, the interest rate of each one of those, and then what is the monthly payment that you could be putting towards them. If you notice, they are prioritized. The highest monthly payment goes towards the highest balance, and then it moves down slowly through the list, kind of proportionately, but not exact. Well, how long would this take to pay off all your debts, and how much would it cost you in additional interest? Because we all know that not only are we paying off this amount of debt, which is about $37,100, but we're also paying off the added interest that comes on top of this the longer that we have it. So as we can see, this is how long it's going to take us to pay off each one of these debts with that same monthly payment, and in total it's going to cost us just under an additional $7,000 to pay off all of those debts. And that's if we focus on paying off the largest balance first. Now, what I will say is these numbers are not exact, right? Because we know that, well, once this one's paid off, that 500 is going to move to pay off the next one 100%. So these numbers aren't completely accurate, but it's the concept that I want you guys to focus on, because this concept can save you a ton of money in the long run. Okay, so that's balance focus. We pay about another $7,000. Well, what happens if we focus on the interest rate, where we're putting our monthly payments, or at least the largest amount, to the largest interest rate? Let's look at this. So the same balance across the same debts. The interest rates are still the same, but now we're paying a different amount depending on which has the highest interest rate. Let's see what would happen there. So in terms of how long it's going to take, I mean, if we're looking at the longest date here, or the longest amount of time, obviously that's much higher than the rest. And then when you look, so again, you know the monthly payments would switch as different debts are paid off. But If we were to do solely just this, and then let's say the money doesn't move, it would actually cost $9,600. But we do know that once the Visa gets paid off and that $500 starts spreading to the next ones, it would actually be a lot cheaper, but it just doesn't show up correctly in this example. But I'm not trying to show you balance focused or interest rate focused. What I want you guys to see is the balance transfer method, right? What happens if we're actually able to move those higher interest rate debts down to something else? So what we've done here is we have a line of credit that is worth $20,000. So you've got $20,000 worth of cash sitting in an account ready for you to use when you need it, and it'll only cost you 4.3% if you ever need that money. So what we've done here is we've taken out 19,100 of that. Well, we already had a balance of 3,000, but basically what we're doing is we're paying off the Visa, we're paying off the MasterCard with what we have left over on the line of credit, which removes these two debts, which now makes, instead of 3 lines of debt with varying rates of interest at varying balances, now we've got 1 line of debt with the line of credit at 4.3%. Okay, and then what we're doing is we're actually taking those monthly payments, we're adding them up here on the line of credit, and then we're actually putting a little bit more towards the student loan as well. Now, what would happen with this? Here's a little interesting thing. We've only got 2 lines of debt. It'll cost, again, you're not moving the payments. This would be a little bit different if we're actually moving the payments once we're paid off. But what you can see is it ends up costing a lot less money in the long run, and it would even be less than this because we would start putting the paid off balance, those monthly payments, towards that next debt. So maybe this is the key. Teaser for you, it is the key. Anytime we can transfer to a lower debt, lower interest rate, this is the strategy we want to do. Okay, as we can see here, we end up paying a lot less, saving almost $4,500 here and about $7,300 there. Not too bad. Okay, now let's talk about those situations that a lot of us have with the mortgage, right? The old mortgage example here, because I know a lot of you will have those as well. Should we be paying off our mortgages early? I say no, and I'm going to show you why. Okay, so same examples as above, but you've gone to finances with Ferg, so you've already transferred your balance. Here it is here. Okay, we're still going to put $750 towards that on a monthly basis. We're still going to put $250 towards the student loan on a monthly basis, but now we've got a $400,000 mortgage at a 3% rate of interest, and we'll be putting $2,000 towards that. Now, with this scenario, how long is it going to take and how much is it going to cost? In total, 206 months to get rid of everything, and then 114 grand. Okay? Now, this isn't lumping anything in, right? This is just pay it off and then the money doesn't go anywhere else. Well, what happens if that debt is paid off? Okay, let's say those debts never existed and all you have is the mortgage. Okay, so instead of being able to put $2,000 towards the mortgage, none of that other debt exists, so you can actually put $3,000 towards the mortgage, right? How much faster would that pay off your mortgage and how much money would you save? Well, you're going to save a lot of time, right? About 69 months actually, you're going to save, and you're going to end up saving about $41,000, give or take. Yeah, about $41,000, and you're saving a ton of months. That's a lot of money saved, right? That looks pretty good. But what happens if you continued to pay $2,000 on the mortgage and you started putting that $1,000 extra towards an investment? Well, let's take a look at that, right? Because if you remember on the previous slides, we had spoken about, does the cost of debt outweigh the income you can make on your investment? That's how you decide what to do. Well, let's take a look. All right. Now, we've got the $400,000 mortgage still. It's still at 3%. We've gone back to paying $2,000 a month, And that additional $1,000 is no longer going towards paying off the mortgage. It's now going to go towards an investment through the TFSA and the Rrsp. We're getting a pretty good rate here. On average, we're getting an 8% rate. Okay, what would happen if you do this? All right, now we know that the mortgage is going to take 206 months as it was up here. So that means we get to invest for 206 months. I think this is about 17 years, if I'm not, yes, it is. Gave myself a little cheat. 17 years, what would happen? Well, it's still going to cost you 112 grand to pay that off. But here's the cool part. You're actually going to make 422 grand from investing $1,000 a month at an 8% interest rate. Meaning that, yeah, you didn't get to pay off that mortgage earlier, but that doesn't matter because you still netted positive 310 grand. All right? Pretty darn good. As you can see, this is why I don't recommend lump summing paying off your mortgage early, because you can actually make a ton of money in the investment. All right? Now, let's go one step further. Let's not get locked into that mortgage we currently have, and let's see what else is out there. Let's see, new mortgage, who dis? All right? We're going to get a better rate on our mortgage because we're going to go out and do the research. We're going to talk to people. We're going to see where they got their mortgage from. Heck, feel free to call me or text me. I could probably get you a better rate than you've got as well. But let's take a look at see what happens there. All right, so still got the $400,000 balance, but now we're only paying 2% interest rate. We're still putting $2,000 in. TFSA and Rrsp, same idea, $1,000. Let's see what happens here. Not a huge difference. You are still getting 40 grand more, so heck yeah, let's get a better rate if we can. But let's take it one step further. Now that we've got this better rate, let's see, now you got to make sure you can do this, but let's see if we can pay a little less and start prioritizing more of our money towards the investment. Guys, this is where it gets crazy, okay? $1,500 at 8%, $1,500 per month at 8%, paying $1,500 to pay off a $400,000 loan at 2%, it will take 272 months, right? 5 more years. Oh, dang, we've got a debt for longer, but that doesn't matter. What matters is how much money you're paying or how much money you're making. Look what happens, guys. A $1,500 per month investment at 8% over 22 years, over $1 million. It doesn't matter that it took you longer to pay off the mortgage, because look how much more money you made in that time frame. All right, you can be walking away with a house and $970,000. Okay, so we need to stop prioritizing paying off the debts as fast as we possibly can. High interest debts, yes, for sure, pay those off. But these low interest debts, like a mortgage or maybe a line of credit at 2 to 3 or 4%, that's basically cheap money. That is carrying good debt, and that is prioritizing your money in a way that you can invest or you can go buy some other asset so you can start making more money while you're using someone else's money to get further ahead. This is the smart way to use debt. This is how the rich are doing it. Our parents, our grandparents, the older generations, maybe for them it made sense to lump sum their payments, to lump sum their debts. But their mortgages were like 60 grand, 80 grand, 100 grand. They were buying whole houses for 200, right? You will be hard pressed to get a house for under 500 grand in Canada today. It's a different world. So we got to look at it a little differently, and we got to attack it a little differently. As you can see here, holding on to a low interest debt is not a bad thing. It is a good thing because we can start prioritizing our money to these investments. And this, guys, is how we can become financially free together. Okay? I hope you really enjoyed this part because this is my favorite video of all time. Now, as I had mentioned before, let's touch a little bit on investing. No, next week will not be our investing episode. It'll be on tax, but the week following that will be on investing. It will be specifically tied to the TFSA and the Rrsp. the most handy investment vehicles, investment accounts here in Canada. So I do want to focus on that. But today, let's give you a little teaser and explain why am I comparing investing and investment accounts to a cardboard box with slots. Please don't shut off the YouTube. I promise you it gets better and it'll make a lot of sense here in a second. So this is Finances with Ferg's TFSA Rrsp Investing Cardboard Box for Dummies. Investing for Cardboard Dummies, sorry. Okay, so I want you guys to think of this box as the TFSA or the Rrsp, okay? I want you to think of these individual slots as the investments, right? So that's the stocks, the bonds, the funds, whatever. Now, just quickly before I keep going on here, just to clarify something, the TFSA, the tax-free savings account, and the Rrsp, the Registered Retirement Savings Plan, are horribly named accounts, right? Savings and savings. These are investment accounts. These should be called TFIA and RRIP. Why? Because these are accounts that need to be used as investment accounts to actually get the full benefit of them. Okay? A lot of people out there, a lot of clients before they come to me, they come to me and say, yeah, I've got a TFSA, I've got an Rrsp. Great, what are you invested in? Well, I just got my money in the account. It's just sitting there. What do you mean? I thought that was the point of the account. No, you're halfway there. All right. And if you're doing this as well, same idea. You're halfway there. This is where the box comes in. So think of the box. You can open the box and you can just lay the money on top of the slots, and that's what a lot of people are doing. People are opening up the TFSA or the Rrsp and they're just putting the money in the account. They're not doing anything with it. But what you need to start doing is actually investing through that. And when you bring this over to the box analogy, you need to start pushing that money down into the slots, okay? Because money in the slots is counting towards buying an investment, and that is the true way to use the TFSA and the Rrsp, okay? Now, you can't just go out and buy an investment. Well, you can, but let's talk about the accounts here for a second. You can't just go out and just buy a random stock, can't buy a random fund. You need to do it through an account here, okay? So how to do that is you got to get the box, because the slots are in the box. So the money can't go in the slots without first going in the box. Money can't go into the investment without first going into the account, okay? Now you can choose as many slots as you want. It's completely up to you, as much as you can afford. That doesn't matter. But here's some differences between the TFSA and the Rrsp. Again, very layman's term, very investing for cardboard dummies. With the TFSA, the box opens and closes freely. You can pull money out. You can put money in. No tax implications. It's pretty free flowing as long as you stay within the contribution limits. I will talk a little bit more about that in 2 weeks on that investing session. But with the Rrsp, think of it as the box has a little pedal on it where the flaps open, but then as you walk away, it closes. When you put money into the Rrsp, for the most part, and almost every single time, you want to leave that money in there. The Rrsp is very much a long-term investment vehicle to plan and save for retirement, okay? You don't want to pull out early from the Rrsp because you're going to be taxed on it, and you're also going to be penalized, right? Now, there are 2 times where you can pull it out without being taxed and penalized. This is to buy your first time you buy a home, first-time home buyers, and then also lifelong learning program, which allows you to go back to school if you want, okay? We'll talk about that more 2 sessions from now, but just for today's session to wet your whistle a little bit, tease you with the cardboard dummies analogy, this you can kind of think about investing in Canada through these accounts like the box with the slots, okay? Now, gang, thank you everybody for tuning in this week. That is it for me. Again, here's my contact information. Feel free to give me a shout, shoot me a message if you have any questions or have some content ideas or whatever. Feel free to shoot me a message and yeah, let's chat. Thanks for tuning in, guys. See you next week.